Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. We've got a stack of sources in front of us today, articles from Yahoo Finance, MarketWatch, CNBC, and Bloomberg, diving into everything from global markets and U.S. politics to international trade, the bleeding edge of tech and AI, and even shifts in the crypto world.
And our goal, as always, is to help you cut through the noise. We're going to synthesize these diverse headlines, pull out the most significant insights, and connect the dots so you can walk away feeling truly well-informed about what's driving the news this week.
Okay, let's unpack this stack then. First up, the market landscape. And there's this interesting debate in the sources, right?
Yeah, basically asking, is Wall Street in for a quiet summer? Or is this just, a calm before maybe another storm?
Exactly. Sounds like a key question right now. And it seems some experts genuinely believe the worst volatility might be over.
That's the argument. It's captured really well in this Yahoo Finance article. The headline is pretty blunt. Extreme volatility is behind us.
Ah, okay. And it mentions experts suggesting investors, take a break?
Yeah, literally, take a summer break. They point to how stocks have bounced back pretty sharply since those Trump tariff announcements back in April.
Oh, yeah, I remember that bounce.
Jeff McLean, he's the CEO of Solidarity Capital, is quoted expressing that view.
Yeah.
And the article points to a few factors supporting this, quiet summer idea.
No, like what?
Well, price action has been relatively range-bound lately, so trading within a predictable band. There's not much clear direction coming from the Fed right now, and maybe relatable for some headline fatigue from Washington.
Headline fatigue, I can definitely relate. And someone else echoes this.
Yeah, Will McGough at Prime Capital Financial. He notes that even long-term Treasury yields have stayed pretty stable, also kind of range-bound between 4% and 5%, despite all the noise.
So his advice is just chill out.
Pretty much. Enjoy the summer, he says, suggesting there aren't really significant near-term catalysts that are likely to disrupt things too much.
But the same article probably throws some cold water on that, right? It can't be that simple.
Exactly. The calendar isn't exactly empty. There are plenty of, let's say, potential spoilers for that quiet summer vibe.
Okay, like what should we be watching?
Well, you've got the Fed's big Jackson Hole meeting in August. That's always closely watched. There's a crucial tariff deadline in early July related to the U.S.-China talks.
We'll get to those talks later, I assume.
We will. Plus, more Fed meetings shaping rate cut expectations. And, of course, the whole saga around Trump's big, beautiful bill as it moves or tries to move through the Senate.
Right, that bill is definitely making waves. We'll touch on that, too. Any historical context here?
Yeah, Sam Stovall from CFRA Research, mentioned in the Yahoo Finance piece, points out June historically tends to be weaker for stocks, usually with mild volatility. He actually calls the recent correction manufactured.
Manufactured meaning?
Meaning driven largely by those trade decisions, those political choices, rather than some underlying economic rot.
Interesting perspective. Politics actively moving the market, but not everyone is so cautious.
No, definitely not. Morgan Stanley's Andrew Sliman, also in that article, offers a more optimistic take. He expects the second quarter to actually surprise on the upside.
On what basis?
He's looking at potentially strong corporate earnings and a generally stable economy.
Okay, so you've got these two camps, basically. Quiet summer versus potential bumps ahead. What's the takeaway for someone listening?
Well, it's not necessarily about predicting which scenario will happen. It's more about understanding the tension, right? The tension between this current calm we're seeing after a rally and these known potential triggers on the horizon.
So managing expectations, be ready for either.
Exactly. And the market numbers themselves show why some feel calm. The sources note the S&P 500 went past 6,000 for the first time since late February.
Wow, 6,000.
Yeah, NASDAQ's highest since February, too. Dow highest since May 19th. And get this, all three major benchmarks closed Friday in positive territory for the year for the first time since way back on February 21st. That followed the stronger-than-expected May jobs report.
So some definite positive momentum there.
For sure. But, and here's the crucial caution from that Yahoo Finance article.
Yeah.
After a big 20% rally, and with the VIX, the fear gauge, being pretty low,
Yeah.
markets might actually be more vulnerable to bad news, to negative surprises.
Yeah.
So that summer break, some experts are suggesting, it could get cut short pretty quickly if one of those catalysts hits hard.
Okay, good point. Vulnerability after a strong run. That makes sense. And speaking of catalysts and tensions, that leads us right into the U.S.-China relationship, doesn't it?
It absolutely does. This is definitely a space where things are far from quiet. We're pulling from multiple CNBC and MarketWatch sources here.
And the big news is talks are happening right now.
Right now. Today, Monday, June 9th, 2025. High-level talks in London.
High-level meaning who?
We're talking top officials. U.S. Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick, Trade Rep Jamieson Greer. They're meeting with China's Vice Premier He Lifeng.
Okay, so serious players. What's the background here? Why now?
Well, the context is pretty charged. You had Trump's big tariffs back in April, then Beijing hit back with retaliation, then there was that preliminary deal in Geneva in May. Remember that?
Vaguely, yeah. A temporary truce.
Kind of. It was supposed to be a 90-day pause, cutting some tariffs. The U.S. dropped rates from like 145% down to 30% on some things. China went from 125% to 10%.
But temporary being the key word, I guess.
Seems like it. Because the sources say since that Geneva deal, both sides have been accusing each other of violating it.
Oh, really? How so?
The U.S. is pointing to China slow-walking approvals for rare earth exports. China, meanwhile, is pointing fingers back about U.S. restrictions on things like visas and access to semiconductor tech.
So, not exactly building trust. What do analysts expect from these London talks, then? A breakthrough?
Not really. The consensus, according to the sources, is don't hold your breath for a quick fix or some grand bargain. It's seen more as part of this ongoing existential battle, is the phrase used.
Existential battle over what?
Over everything, really. Tech, AI, defense, who leads the global economy in the digital age. It's deep structural competition.
Okay, so low expectations for the talks themselves, but what about the actual trade data? What does that show?
Yeah. The China-made trade data, which CNBC reported on, is pretty revealing. Overall exports from China were up 4.8%, but...
Yes, there's always a but with this story.
Right. Exports specifically to the U.S. plunged, down a massive 34.5% compared to last year.
Wow, 34.5%. That's huge.
It's the sharpest drop since February 2020, so early pandemic days. And U.S. imports into China also dropped significantly, over 18%.
So that bilateral trade U.S.-China is really shrinking.
Definitely. China's trade surplus with the U.S. shrank by over 41.5%. The insight here is pretty clear. The tension is causing a real decoupling, at least in direct trade, between the two.
But you said China's overall exports were up. How does that work if U.S. trade plummeted?
Good question. The sources show they made up for it elsewhere. Strong growth in exports to other regions.
Like where?
Southeast Asia, exports jumped nearly 15%. To the EU, up 12%. Africa, even more, up over 33%.
So they're diversifying away from the U.S. market. Actively.
Seems to be the strategy.
Yeah.
The takeaway is China is actively shifting its trade relationships. Now, interestingly, CNBC also reported something that could be seen as a bit of an olive branch from China.
Oh, on what?
On those rare earths the U.S. was complaining about. China's Ministry of Commerce said it would set up a green channel to speed up export licenses, specifically for EU firms.
Okay, for the EU. What about the U.S.?
Well, also, crucially for industries like automotive, China reportedly granted licenses to suppliers for the big U.S. auto giants GM, Ford, Stellantis.
Ah, that's important. Weren't there warnings about production shutdowns?
Exactly. European auto groups like ACEA were sounding the alarm. Suzuki apparently even had to suspend production of its Swift car because of shortages. These were linked back to China's earlier export restrictions, which themselves were seen as retaliation for Trump's tariffs.
It's like a tit for tat that ripples through supply chains. Yeah. And China holds the cards on rare earths, right?
It dominates, something like 60% of global production. So yeah, significant strategic leverage there.
One last point on this. Did the talks affect markets at all?
Just a little tremor. CNBC noted Treasury yields dipped slightly ahead of the talks. It shows how sensitive markets are to even the idea of dialogue, even if big breakthroughs aren't really expected.
Okay, so for you listening, the insight here is crystal clear. These trade tensions, these shifting trade flows, they aren't just political headlines.
Not at all. They hit global supply chains. They affect manufacturing costs. Think about car prices. If rare earths get squeezed and they sway overall market sentiment. Politics is absolutely shaping economic reality on the ground here.
Right. From global trade, let's pivot back home then. U.S. political crosscurrents and their economic impact. We're looking at MarketWatch and CNBC again here.
And the big story continues to be Trump's big, beautiful bill. It squeezed through the House. Now it's bogged down in the Senate.
And this bill sparked quite the public fight, didn't it, between Trump and Elon Musk?
Yeah, that was unexpected. Musk came out swinging, called the bill a disgusting abomination.
Strong words. Why?
He argued it would explode the national debt, threaten economic stability. He even went on social media telling people to lobby Congress against it.
And Trump's reaction was predictable.
Swift and furious. Told reporters his relationship with Musk was now irreparable. And he threatened serious consequences if Musk backed Democrats who oppose the bill. High drama.
Wow. What about Congress? How are they reacting to this billionaire feud?
House Speaker Mike Johnson basically shrugged it off, confident Musk wouldn't derail the bill. According to MarketWatch and CNBC, he downplayed Musk's influence, said he didn't write the bill to please the richest man in the world.
And what about the bill's actual impact, the CBO numbers?
Johnson disputed those CBO forecasts. Remember, the CBO, that's the Nonpartisan Congressional Budget Office, they projected the bill, adds $2.4 trillion to deficits over 10 years.
Trillion, with a T.
With a T, and results in about 10.9 million people losing health insurance. Johnson argued the standard Republican line: tax and spending cuts spur growth that offsets the costs. Though the sources do note historical examples where that didn't quite pan out.
And the Senate's take on the Trump-Musk spat.
Some, like Senator Markwayne Mullin, seem to want to stay out of it. He apparently compared their dynamic to a marriage and said he preferred not to intervene between the two fighters.
Sounds wise, maybe. Now, buried in this huge bill, CNBC highlighted a specific part causing alarm bells. Section 899.
Yeah, analysts quickly dubbed it the revenge tax. It's complex, but the gist is...
Layman's terms.
Okay, it lets the U.S. hike taxes up to 20% a year on foreign companies with U.S. investments if their home country imposes taxes the U.S. deems unfair. Think global minimum taxes, digital services taxes, those kinds of things. It also expands an existing tax called the BEAT.
Unfair according to whom? The U.S., presumably.
Presumably. And the reaction from Wall Street, according to CNBC, it was shock.
Shock. Why?
Big concerns about the hit to the asset management industry and how it might scare off future foreign investment into the U.S. The Investment Company Institute, which represents asset managers, even issued a warning.
But it's still in the bill.
Apparently, it's a strong priority for some House Republicans.
Yeah.
It's estimated to raise maybe $116 billion over 10 years, which helps pay for the rest of the bill. And the goal seems clear: pressure other countries to change their tax policies.
Using U.S. tax code as a weapon in global tax fights.
Okay.
Any other political news impacting the economy?
A couple other things. MarketWatch reported the Supreme Court gave the Department of Government Efficiency, DOGE, access to Social Security data.
DOGE. That was Musk's initiative originally, right? Even though he stepped down.
That's the one. And the decision immediately reignited privacy concerns. The court's liberal wing dissented strongly, citing grave privacy risks.
Access to Social Security data. Yeah, I can see the concern there. And one more thing.
A new travel ban from Trump. The Associated Press reported it's set to take effect today, Monday, covering 12 countries, mostly in Africa and the Middle East.
Another travel ban. How is this one different?
Experts quoted say it seems more carefully written this time, likely to try and survive court challenges better than previous ones. It focuses on the visa application process, citing security risks based on a Homeland Security report.
But there's criticism.
Well, yeah, aid groups are denouncing it, saying it sows division. And the sources point out that the specific Boulder attack Trump mentioned actually involves someone not from a listed country who was here on an expired visa, so the connection isn't direct.
Okay. So lots of political movement with real economic ripples. What's the main insight for listeners here?
It's that these political developments, they aren't just abstract news stories. They have real, tangible impacts on trade, on tax policy that affects businesses and your investments, on government data access, on international relations. All these things ripple through the economy and the markets.
Got it. Politics matters. Let's shift gears completely now. From DC drama to the cutting edge, tech and AI. What's happening there?
Some really fascinating stuff, drawing from multiple sources again. First up, MarketWatch reported on a new AI research paper from Apple, just ahead of their big developer conference today.
Apple and AI. They're trying to catch up, seems like. What did the paper find?
They tested various reasoning models from OpenAI, Google, Anthropic, DeepSeek by giving them puzzles. The finding: accuracy dropped as the puzzles got harder, eventually hitting complete collapse. Zero accuracy.
Complete collapse. Okay, that doesn't sound great.
It gets weirder. The models apparently also started putting in less effort, less reasoning, as they got close to that collapse point. The researchers called it a quitter's mentality or even laziness.
Laziness in an AI.
That's the term they used. Most pronounced in OpenAI's O3 mini model. And get this, even giving the models the correct algorithm to solve the puzzle didn't help improve performance once they hit that wall.
Wow. So AI reasoning isn't quite solved yet. Especially relevant given Apple's perceived lag in AI, right? after that Apple Intelligence rollout last fall using ChatGPT tech.
Exactly. It shows there are still some really fundamental, tricky challenges in getting AI to truly reason effectively, despite all the hype and investment. The insight is progress isn't always linear.
Meanwhile, Meta might be making a huge AI bet. Bloomberg reported on that.
A potentially massive one. Meta is reportedly in talks for a multi-billion-dollar investment in an AI startup called Scale AI, possibly over $10 billion.
$10 billion into an external startup. That sounds unusual for Meta.
It is. They usually rely heavily on their own internal research. This would be their biggest external AI investment ever.
So what does Scale AI do that's worth potentially $10 billion to Meta?
Data labeling, which sounds boring, but it's absolutely critical for training AI models. Scale provides this service to big players like Microsoft and OpenAI already. Their business is booming, expecting $2 billion in revenue in 2025, up from $870 million last year.
Data is the new oil and labeling is the refinery, sort of.
Good analogy. And this fits with Zuckerberg's huge focus on AI. He's planning to spend up to $65 billion this year, wants Meta's Llama model to be an industry standard. Interestingly, both Meta and Scale are also involved in defense tech work.
Okay, so foundational AI infrastructure, like data labeling, is becoming super strategic, attracting huge money. What else in tech?
Qualcomm made a big move, also reported by Bloomberg. They're buying a UK chip firm, Alphawave IP, for $2.4 billion cash.
Why Alphawave?
It's all about AI. Qualcomm wants to expand beyond the slowing smartphone market into growth areas like data centers, AI chips. Alphawave makes the high-speed connectivity tech needed for those AI applications.
So retooling for the AI era, was it an expensive acquisition?
Very. A 96% premium over Alphawave's stock price before the talks started. Shows how serious Qualcomm is about this shift. Expected to close early 2026.
Okay, another big bet on AI infrastructure. What about Sam Altman's other project, WorldCoin?
Yeah, Bloomberg covered their expansion. Tools for Humanity, Altman's company, is rolling out those eye-scanning orbs in major UK cities now, part of a global push.
That eye scanning thing? Remind me, what's the point again?
It creates a unique world ID from your iris scan. The idea is to prove you're human, not an AI bot or a deepfake, in the future digital world. You get a WorldCoin token if you sign up.
But wasn't there controversy around privacy?
Oh yeah, big time. The company says it doesn't store personal biometric data, but they've faced regulatory probes in Germany, Argentina, outright bans in Spain and Hong Kong, huge privacy concerns. Still, 13 million people globally have apparently done the scan.
13 million, wow. So the insight is this growing tension between proving identity online in the AI age and, well, massive privacy risks.
Exactly. And one last tech bit. The UK's financial regulator is actually partnering with tech on AI. CNBC reported this.
Partnering how?
The Financial Conduct Authority, the FCA, is teaming up with NVIDIA. They're creating a supercharged sandbox starting in October.
A sandbox, like a safe space to play.
Essentially, yeah. For banks to safely experiment with AI using NVIDIA's tech, it's trying to tackle the real challenges banks face using AI worries about privacy, fraud risks, like LLMs sending data overseas, or AI being used for sophisticated scams.
So regulators trying to enable innovation while managing the risks? That's interesting.
Yeah, the insight is this proactive approach, collaboration, to figure out how to use these powerful tools safely in sensitive sectors like finance.
Okay, so summing up tech. The AI race is intense, big money flowing, but also hitting real roadblocks like reasoning, and huge questions around data, privacy, and responsible adoption. Lots to track there.
Definitely.
All right, let's move on. Finding opportunity, maybe looking beyond the usual suspects, outside the S&P 500, maybe into crypto.
Yeah, a couple of interesting articles touch on this. First, Bloomberg highlighted a really significant Bitcoin buying plan from a Japanese company, Metaplanet.
Metaplanet, what are they doing?
They plan to raise $5.4 billion, billion with a B, specifically to buy more Bitcoin. They already hold about $1 billion worth.
Whoa, how much Bitcoin are they targeting?
The goal is 210,000 Bitcoin by the end of 2027. They currently have around 8,888. If they hit that target, it's roughly 1% of all Bitcoin that will ever exist.
1%. Held by one company. That's a lot. Are they the only ones doing this?
No, the article notes they're explicitly following the Michael Saylor MicroStrategy playbook, and it's part of a growing trend.
What trend?
Listed companies raising money through equity or debt, specifically to buy and hold Bitcoin on their balance sheets.
Any other examples?
Bloomberg mentions 21 Capital, which launched holding nearly $4 billion in Bitcoin, and even Trump Media and Technology Group allocated $2.32 billion for a Bitcoin treasury recently.
So companies are becoming big Bitcoin buyers. What's the significance?
An analyst quoted in Bloomberg called it a new and material incremental source of buying demand for crypto. And apparently, investors are eager to fund these capital races. The insight is corporate treasuries are now a noticeable non-retail force potentially supporting Bitcoin's price.
Interesting. Okay, shifting from crypto to traditional markets, but still looking beyond the usual. MarketWatch had a piece arguing for value outside the S&P 500.
Exactly. The core idea is that after years where expensive markets kept getting more expensive, 2025 has seen a flip.
A flip how?
Well, the U.S. market, measured by the KPE ratio, that long-term valuation metric, is seen as one of the most overvalued globally.
Right.
Only India is higher among countries tracked.
Okay, U.S. looks pricey long term, so.
So the striking thing this year,
Oh.
according to the data cited, is a significant negative correlation between starting valuations, CPE ratios, and year-to-date returns. Meaning countries that started 2025 looking cheaper based on KP have generally performed better so far this year. Lower KP equals higher returns in 2025, basically. That's a big change for the last decade.
Can you give an example?
Poland is the prime example used in the article. Started the year with the second lowest KPE ratio, year to date. Best performer in the database used, with the iShares MSCI Poland ETF apparently up a massive 44.6%.
44.6% compared to the S&P 500's, what, 2.1% you mentioned earlier? That's a huge difference.
It really is. Now, it's not like every single cheap country is soaring, but the article shows that on average, the lower valued markets are significantly outperforming the high CP ones like the U.S. so far this year.
So what's the strategy then if you buy into this?
Well, the sources suggest a couple of approaches. You could invest more broadly outside the U.S., maybe using a global ex-U.S. ETF, like the iShares MSCI ECWI ex-U.S. fund.
Or get more specific.
Or target specific countries with low CAPE ratios that some newsletters mentioned in the article are recommending, like Italy and Germany. There are ETFs for those too, like the iShares MSCI Italy and Germany funds.
Is this trend guaranteed to last, though?
No guarantees, of course. The article acknowledges that, but points out the valuation spreads between the cheapest and most expensive markets are really wide right now, suggesting there might be room for this value trend to continue.
Okay, so the insight for listeners is don't just focus on the big U.S. indexes. There might be opportunities, or at least diversification benefits, in looking at alternative assets like Bitcoin via these corporate buyers, or exploring these potentially undervalued international markets, especially if this valuation matters trend holds up.
Precisely. Challenges the idea that you just keep riding yesterday's winners.
Okay, let's try and bring this deep dive to a close. We have covered a lot of ground today. Phew.
We really have. From that whole debate about market volatility, summer calm, or storm ahead, through those super tense U.S.-China trade talks happening right now.
Right, and the political battles here in the U.S. over that huge tax bill, privacy issues, the travel ban.
Then shifting to the AI race, the breakthroughs, the investments, but also those surprising scumbles like Apple's reasoning paper findings.
And the corporate Bitcoin buying trend, looking beyond the U.S. for stock market value. It's a complex picture.
It really is. What seems clear is how much political currents, both out of Washington and Beijing, are genuinely driving market fundamentals and global trade flows right now. It's not just noise.
And meanwhile, that tech race just keeps accelerating. Opportunities, sure, but real challenges too.
Definitely. And the search for investment value seems to be pushing people to look at assets and regions maybe they haven't considered seriously in a while.
We really appreciate you sending in these sources. Diving into them this way, you really start to see the connections, don't you? Between things that seem separate on the surface.
Absolutely.
Yeah.
So for you, listening and trying to navigate all this information, what's the big takeaway? I think it's that interconnectedness, how a tariff here affects costs there, how a tech development raises global questions, how domestic politics impact international investment.
Yeah, and the importance of looking beyond just the main headlines, right? To see those underlying drivers, the potential risks, the opportunities may be hidden in the less obvious places.
Exactly. Now, here's something to maybe chew on, a final thought.
Okay, lay it on us.
How much of everything we just discussed, the market swings, the trade tensions, even specific investment trends like companies buying Bitcoin or favoring certain countries, how much is driven by real fundamental economic shifts versus how much is the market just reacting, maybe overreacting to political theater, to rhetoric, to, billionaire tweets even?
That's a good question. How much is signal? How much is noise generated by politics and personalities?
Right. And if political decisions and unpredictable events can cause such big, rapid shifts, how reliable can any market prediction or economic forecast really be in this kind of environment?
Something to definitely mull over. How much faith can you put in forecast when the rules can change so quickly based on political winds?
Exactly. Food for thought as you watch the markets in the news this week.
Indeed. Okay, and with that provocative thought, we'll wrap up today's deep dive into the headlines. Thanks for tuning in to the Pro Ticker Podcast.
We'll see you all tomorrow morning with new headlines from major financial magazines.